All right, why don't we go ahead and get started? Good morning, everybody. My name is Steve Mahoney. I am a mentor with the Greater Hartford chapter of SCORE. Today, we're going to be talking about financial fundamentals for business owners. And before we jump into today's content, I'm going to turn it over to my colleague with SCORE, John Sundin, to tell you a little bit about our chapter.
Hi, everybody. So really quickly on SCORE. SCORE has been around since about 1964 and started with a simple idea, which was to recruit retired business executives and business owners and ask them to volunteer as mentors to small business owners and to startups. So we've been doing that since the 60s. We now have well over 10,000 volunteers nationwide. We provide free advisory services. We provide workshops like this one and webinars. We have a website with lots of tools and templates. Almost everything we offer is free, and I say almost because we do offer some live workshops that occasionally will have a modest price tag associated with it for printing and meals, anything else that we bring in. But other than that, it's all free. We have lots of experienced volunteers who can really help you with almost anything from business planning to things like we'll talk about today. So if you have questions about SCORE and how we work with clients, we'll be happy to take them at the end. And you can always go to score.org and you can request a mentor, you can find workshops, and you can find all kinds of great stuff. Last thing I'll mention is that everything you do with a SCORE mentor is confidential. So everything you tell your SCORE mentor about your business is confidential. All of our volunteers sign a code of ethics annually that pledges them to maintain your confidentiality. So like I said, if you have questions about SCORE, please save them to the end and we'll be happy to help.
All right, thanks, John. So today, we're going to talk about financial fundamentals. My background is in finance. I joined SCORE a few years ago, but I spent about 25 years in various finance and accounting roles throughout my career. So this is something that I actually help a lot of clients with in my mentoring role with SCORE. So just to go through what we're going to cover today, we're going to talk about why managing your business finances is important. There's a few obvious ones, but maybe a few not so obvious ones. We're going to go through some key financial concepts and how to read your financial statements and understand your financial statements. The three main ones are the income statement, the balance sheet, and the cash flow statement. We're going to talk about where to start. Sometimes people know that they need to manage their financials, but they don't kind of know where to start with this process. We're going to talk about how you can turn data into action, and then some key tips for success that I'd like you to take away from this. If you have questions as we're going throughout this, you can feel free to put your question in the Q&A box or the chat box. John's going to keep an eye on that, and we'll make sure we save some time at the end for questions. So let's jump right in. So why is it important to manage your financial statements? The first one that people usually think of is for their taxes. And that is an important aspect of keeping an eye on your financial statements every single month. So you want to make sure you have good record keeping for your tax purposes. This is the time of year where everyone is getting ready to file either their tax return or file an extension for their tax return, and working with their CPA. And the more you keep an eye on this throughout the year and keep tight records, the better your tax experience will go through at the end of the year. And that's important, but it's not the only reason why you want to do this. The most important thing really is try to understand the trends in your business and what's going on in the market. I always like to think about the financial aspect of a business being the past can help inform the future. What's happening with your sales revenue? Is it increasing or decreasing? How are you seeing the pricing market with your competitors? Are customers still engaged with your pricing? Are they starting to go to competitors because they're seeing a better price or a different product offering? Using your past financial results can help make future business decisions. And that's one way to think about. It's not only it's not only important to look at what happened in the past, but we're going to talk about this in a few minutes about how to take that information and turn it into action for the future. So this can be a really important aspect of understanding your financials. It can also help you answer some really key questions. So as you look at your financial results, you may look at your bank account week to week and say, gosh, I wish there was more here. I wonder if I could be making more money. Well, understanding your financial results and what's happened in the past and using that to help predict the future can help answer that question. Are you able to make more money? And if so, how? It can help you understand if your product or your service is priced right. If you're starting to see a trend where your revenue is flat, but you've increased your prices. Maybe the customers aren't seeing the value for your product or service anymore, and you maybe need to rethink that approach. You could also use your financial results to help understand what your business may look like in 1 to 3 years. A lot of times people get started out and they think, okay, I'm going to see if there's a proof of concept with this product or service, but I can make any money on it. But then you may want to ask yourself, what could I do with this? Where could this thing grow to in the next few years? So again, going back to, it's important for tax purposes to keep an eye on your numbers, but understanding your financials in depth can really help you drive your business to greater heights in the future. So next, we're going to talk a little bit about some key financial concepts, and we're going to start with the income statement. So this is probably the most common financial statement that people look at. You may hear it referred to as a profit and loss statement or a P&L. If you hear income statement, profit and loss, or P&L, it's all the same, just different terms to describe the same financial statement. So the thing to remember about an income statement is that it measures profitability over a period of time. So you could look at your income statement for a month, for a quarter, which would be 3 months, or for a full year. So if you are using QuickBooks, let's say, and you want to run an income statement, you're going to look at an income statement, and let's say you pick January 31st. It's going to give you the income statement for the month ended January 31st, or for the quarter ended March 31st, because it's 3 months, or the year ended December 31st. So it measures profitability over a period of time. And the other thing to remember with an income statement is you don't cross calendar years. So it's not like you're going to look at December, January, and February together, because that's not the way you look at it. Once you close out your calendar year in December, you start the next year clean in January, looking at a new fiscal year. So here are the major items that you'll see in an income statement. We're going to talk about what each of these are and why they're important. And then I've got a sample income statement that we're going to go through in detail in a minute. So you may hear revenue or sales. This is basically money that you've collected for selling your product or service. Sometimes people use the word income. I think of income as more akin to profit. So I like to use revenue or sales or gross sales, top line sales. That's the money coming in the door before you pay any of your expenses. So if you use revenue or sales on that terms of that top line number, that'll avoid any confusion. Cost of goods sold. So this is if you are selling a product, this is the cost that you paid to acquire the product. So this is really applicable in retail or manufacturing. So let's say you're selling t-shirts and you work with a vendor overseas and you design the t-shirt and you buy them for $8 a unit and you sell them for $12 a unit. The $12 would be your revenue or sales. The $8 would be your cost of goods sold, because that's what it costed you to acquire the product. In retail, in manufacturing, if you're producing something, let's say you've got a factory and you're making machine parts, the amount of money it takes you in terms of material and labor to build that product before you sell it, that would be the cost of goods sold. So the next item is gross margin or gross profit. So this is really sales minus cost of goods sold. This is not your bottom line profit because it doesn't take into account other expenses, but this is an important one for product businesses. It's not really applicable for service businesses, because if you're running a consulting business, you don't really have cost of goods sold because you're selling your time. You're providing consulting services, maybe you're billing out at an hourly rate. You don't really have cost of goods sold. So gross margin or gross profit is not really an applicable concept. But in my earlier example about the t-shirt, if you sold your t-shirt for $12 and it cost you $8 to acquire it, your gross margin would be $4 per unit. So that's an important concept to understand, because you want to get that gross margin per unit as high as possible. And you can do that by either selling more, selling your item at a higher price. Both of those increase your revenue. Or if you can get your product cheaper from your vendor, you can lower your cost of goods sold, which increases your gross margin. So thinking about the levers in your income statement. The next item is the operating expenses. So these are really the costs to run your business. So this is your rent, your utilities. If you pay an accountant, if you pay an attorney, anything that it costs to run your business that is not part of your cost of goods sold. These can be either fixed or variable. Fixed costs are generally ones that stay, they're sometimes called overhead. They generally stay the same month to month. So think your rent, your business insurance. The variable costs are going to be ones that increase or decrease over time with your sales revenue. So an example of variable costs might be marketing costs. If you enter into a really busy season and you increase your marketing costs because you're going to have more revenue, let's say you've got a seasonal business like a landscaping business. Maybe you hire more staff during the summer. Maybe you do more advertising during the summer. Your sales revenue is going to be higher. Those costs would be variable because they're going to be higher. It's important to understand the difference between fixed and variable costs because your fixed costs are always going to be there regardless how big or small your revenue is. So if your revenue goes way up and you've got a certain amount of insurance or rent costs, those costs are not going to go up just because your sales revenue went up. But it's also important to know that if your revenue goes down, you still need to make sure you've got enough money to cover those fixed costs because they're not going to go away just because your revenue went down. So understanding your cost structure between fixed and variable is very important as part of managing your income statement. So the last item is called profit, or sometimes called pre-tax income. So this is the math that you'll see on the next page is sales minus cost of goods sold minus operating expenses. And that's your profit before income taxes. So here's a sample income statement, and this is just made up numbers, and this is for either a manufacturing or a retail company because you can see on the left-hand side, they've got sales of $1 million, they've got cost of goods sold of $350,000, and their gross profit is $650,000. And then they've got their expenses. So you can see all the different categories here that they've got, and these are the expenses that are it costs to operate the business. And then you come down to your operating profit. And then this business has debt with a bank, so they're paying interest on their debt. And then they've got taxes that they've got to pay for their profit, and they get down to net profit, net income. And then these are the key questions you'd ask yourself as you're looking at an income statement. So in gross profit, how much is my profit generating in profit before I pay my expenses, right? That's that, $4 per unit example I gave earlier. When you look at your expenses, understanding which ones are fixed and which ones are variable, are there ways I can become more efficient to bring these numbers down? Can I do without some of my legal or regulatory costs, or can I get a better deal on my insurance, for instance? And then net profit, how much did I make after I paid my taxes? So this is a pretty standard income statement, pretty simple example. Might be similar to how you look at things when you're running reports out of QuickBooks. All right. So the next financial statement to look at is called the balance sheet. And one difference between the income statement and the balance sheet is, if you remember, I said the income statement covers your financial activity over a period of time. So over a month, over a year. The balance sheet takes a snapshot of your business at a point in time. So whenever you run your balance sheet, it's always an as of date. So as of March 31st, as of December 31st. There's no such thing as give me the balance sheet for the month ended January 31st. It will show you as of January 31st, what does your business look like? So think about your balance sheet taking a picture of your business as of that date, because as of February 1st, your balance sheet is going to change because there's going to be different activity, because the picture will change because another day has gone by. There's three main components of a balance sheet. And you'll see on the example on the next page why it's called a balance sheet, because the balance sheet is always in balance. So the formula is your assets equals your liabilities plus your owner's equity. So what are all these different items mean? So think about your assets being what your business owns or what others owe your business. So what that means is, and these are some examples right here. So your cash in your bank, if you've got any investments in your investment account. What I mean by what others owe your business is accounts receivable from customers. So example would be, you sell a product today, you ship it to a customer, and they've got 30 days to pay you. Today's January 31st. This is a good example. If I ship that product today, I've sold you my product, but you don't pay me for another 30 days. As of January 31st, I have an account receivable from you. That's an asset to me. I no longer have the inventory. I've given you your asset, but you haven't paid me my cash yet. So that's a good example of accounts receivable. any inventory you have on hand, if you're a manufacturing or retail company, any property, machinery, equipment, like if you've got anything in a machine house or a restaurant, things like that. The next component are liabilities. So this is what your business owes to others. And again, we're talking about the business here, not you personally, but your business entity. So this would be accounts payable to vendors. So let's use the example of January 31st. Someone comes in and does work for you this past week. They did work for you in your restaurant. They did some repairs and you owe them money, but you haven't gotten a bill yet. You're going to pay them. You've incurred an expense in your business. You just had a $10,000 expense that you've incurred. Your balance sheet as of today would indicate that you have a $10,000 payable to that vendor that you may pay in a couple of weeks. So again, as of today, you've got that liability because you've incurred that expense. You owe them that money. That's a liability to the vendor. Other examples would be if you owe taxes to the IRS or to the state. If you owe debt to a bank, if you've taken out a loan, that would show up as a liability. Owner's equity is the last component of a balance sheet. This is sometimes called the book value of your company. And I'm going to distinguish that from fair value. If you're looking at your balance sheet and you see your equity and you say, oh, I wonder if this is what my company is worth, it's not. The owner's equity of the business on a balance sheet is what's called the book value of the company. And that's different from fair value, which I'll talk about in a minute. But book value is a simple calculation that is highlighted below. And it's basically any money that you've put into the business over time, since the beginning of time. If you put $10,000 of your own personal cash into your business bank account, you've created equity. You've added to your equity because you put that $10,000 in. As your business makes profits over time, your equity goes up. And if you take money out of the business, if you take an owner's draw, your equity goes down. So the equity over time is simply calculated as money going in that you put in, capital contributions, plus profits that you make, minus owner's withdrawals. And it's ever since the company's inception. Fair value is a different concept. So for instance, sometimes we'll work with clients and they'll say, I'm thinking about selling my business in a couple of years and my book equity is $20,000. Is that what I'm worth? Or $100,000? Is that what my company's worth? And the answer is no. If a company were to be looking at buying your company, they're going to do what's called a fair value analysis. And they'll look at your balance sheet because they want to understand your assets and your liabilities, but they want to understand the future potential of your business. And they'll do things like, show me your projected cash flow for the next 3 to 5 years. And they're going to use that analysis to help determine what they think your company is worth. Because they're buying on the potential of your business, whereas the book value of your equity and your owner's equity on your balance sheet is a reflection of what's happened in the past. A prospective buyer is more concerned about the future. So I only mention that because a lot of times when we're going through equity of a balance sheet with clients, they say, is this what my company is worth? And I wanted to distinguish that to say that's a different kind of analysis. So let's look at a typical balance sheet. So again, these are just made up numbers. The first thing I'll point out is the assets are always on the left-hand side. The liabilities and equity are always on the right-hand side. You can see that the balance sheet is in balance. Every balance sheet will always be balanced. That's just the formula and how it works. This business has total assets of $910,000. They've got liabilities of $450,000, equity of $460,000. You add the two together, you get $910,000. That's just the way the accounting rules work for a balance sheet. So let's talk about in a little bit more detail. So the assets on the left-hand side of the balance sheet, these are all items that we own, the business owns, or that people owe us. Your balance sheet always starts with the most liquid assets and goes to the least liquid assets. And what that means is your cash is always going to be first on a balance sheet. Any balance sheet you look at in any company, the first asset is always going to be cash because it's the most liquid asset. It is money that you could draw down out of your bank today. Then as you go next, the next items are in order of the time it takes to convert them into cash. Think about it that way. Short-term investments. This business has $50,000. It's probably in like CDs or like money market funds. they can easily turn that into cash. Accounts receivable from customers, $75,000. This item is going to turn into cash because I've already sold my customer a product and they're going to pay me relatively quickly. Inventory. So this is a retailer or manufacturing company. They're going to sell that inventory and turn it into cash. Prepaid insurance. This is where you may pay your insurance expense in advance. Maybe they give you a better deal if you pay your annual insurance premium all at once. The accounting rules say that's a prepaid expense because you've paid it in advance. That'll quickly get amortized into your income statement. Then this business has things like long-term investments. So they've got some stocks, they've got a life insurance policy. These, are a little bit longer term as thinking about turning them into cash. And then usually the last things on a balance sheet are property, plant, and equipment, sometimes called PPE. And you can see they've got land, they've got building and equipment. The reason these are usually at the lower end of a balance sheet is because these would take a long time to turn into cash. So if you think about it, if you're in dire cash needs, let's say you're worried about your business, revenue's dried up, and you've got some expenses coming up, and you look at your balance sheet and say, how can I quickly get some cash? The first thing you want to do is collect your receivables and then make sure you're starting to sell your inventory. But if you think about, well, I'm going to try to sell some equipment, that's going to be really hard to do because you got to find a willing buyer who's going to be willing to pay you a reasonable amount of money that you'll accept quickly and be able to pay you in cash quickly. So that's why a balance sheet tends to go from current to long-term because it just helps kind of tell the story of what's going on with the business. This is also important when a bank is looking at your business balance sheet. They're going to want to understand what's called your liquidity. So if they see a business that has got, really low current assets and a lot of money tied up in, land and building and equipment, and they're really thin on these current assets, they might be worried about their ability to sufficiently pay their debt. They may not be, but if the cash flow could be pressured, they may say, well, wait a minute, if these guys are going to struggle for their revenue and their cash flow, they don't have any assets that they can quickly turn into cash. So that's why when we're looking at balance sheets, we tend to look at not only the quality of the assets, but how much are current and how much are long-term. And these current assets are the ones that turn into cash quickly. The last item to mention on here is goodwill. This is not very common. Goodwill comes up when you buy another company. And it comes into kind of how the accounting for an acquisition gets put into the books and on the balance sheet. It generates goodwill. It's probably too detailed of a conversation for today's webinar, but in case that was a question that comes up. Let's go on the other side of the balance sheet. So there's liabilities come next. Just like the asset side, these are broken out into current and long-term. So you can see that thinking about the current liabilities being the ones that you're going to pay quickly. Accounts payable, you're going to pay your vendors quickly, right? Usually 30, 60, 90 days. Salaries payable, you're going to be paying your payroll every week or two. Interest on your debt, you're going to have to pay pretty quickly. Income taxes, you definitely want to pay quickly. There's two things to mention about debt here. One is current portion of note. You can see a $40,000 piece, and then you can see other debt down here. The way to think about current liabilities is this is money that you're going to pay within the next 12 months. Long-term are any liabilities that are going to get paid beyond 1 year forever. So in this instance, this business has got a $150,000 note payable, $40,000 of which is due in the next 12 months. $110,000 is due 12 months and beyond. So that's also important in looking at a balance sheet, because a bank will say, if you just had a balance sheet that says, I've got a $150,000 note with this bank, one of the questions they're going to say is, tell me the maturity schedule of that note. How much is due in the next year, year 2, year 3, year 4? Because they want to understand how much debt committed do you have already, and are you going to be able to manage those debt payments with your projected level of revenue and cash flow. Last item is equity. We talked about this earlier. So capital stock, this is basically money you've put in, less money you've taken out. These are your capital contributions minus your owner's withdrawals. Retained earnings is your accumulated profit over time. So every time you earn profit, thinking about it getting added to your retained earnings every time you close your books. John, any questions we should answer? I thought I'd just pause here.
I guess if people have questions about goodwill, you said that doesn't apply in a lot of cases, but if you do, this is a good time to ask.
Okay. If we hear anything, we'll chime in. Okay. So the next one, the next financial statement is called a cash flow statement. So this is a pretty simple one. It's measuring cash moving in and out of the business over a period of time. So similar to the income statement, you're looking at cash flow for a month, a quarter, or a year. And this is pretty intuitive. Cash flow is positive when your receipts exceed your disbursements, and it's negative when your cash flowing out exceeds your cash flow coming in. There's three ways to look at your cash flows. There's operating, there's investing, and financing. We're going to talk about those in a little bit more detail, but this is helpful because your cash flow statement and your income statement are very similar to each other, but depending upon how quickly you collect cash or pay cash with customers and vendors, it could be pretty different. So that's why it's important to look at your cash flow statement as well. So let's talk about inflows and outflows from operating cash flows. So this is one of the main categories here. So your cash inflows, service revenues, or your revenues from sales of products, right? It's very similar to the income statement. It's money coming in the door. Your cash outflows, it's pretty similar to your expenses on your income statement, your cost of goods sold, and then all the operating expenses for your business. The key concept that we talked about earlier in the income statement, you want to understand your fixed versus variable expenses, because especially if you've got like a business that's seasonal. So if you think about a business that's like a landscaping business where they're really busy in the summer months, but they're really slow in the winter months, maybe they do some snow removal, but they're really slow. They need to make sure they understand the timing of their cash flow over the course of the 12 months, because they may have rent expense they're paying in December, January, and February, but they don't have a lot of revenue coming in. So they need to understand which expenses are fixed and variable so they can manage their cash flow thoroughly over the course of a year. So there's two other categories of cash flow. There's financing and investing. For financing, so this is basically money that is either the main part is really if you're working with a bank. So if you borrow money from a bank, again, this is your business. Your business borrows money from a bank. It's money coming in. When you make payments on that loan, that's money going out. If you also think about that equity concept we talked about earlier, where you're putting money into the bank, you're contributing capital into the business. That's an inflow into your business cash flow. And anytime you take an owner's draw, that's an outflow of cash. Investing. So this is where you're putting money into your business. If you're going to make a capital investment, let's say you've got your business has been doing really well and you've got a truck that is out making service calls, but it's really getting old and it's getting up there and you're thinking you need to replace it. And you decide to, purchase a new piece of equipment or a new vehicle. That's making an investment into your business. It's kind of difficult to figure out when to do this because you've got to understand what's your potential cash flow look like in the future, and can you afford it? And is it going to help generate profit? And profit can be generated in one of two ways. It can help you increase revenue, or it can help you lower expenses. If you're running a machine shop and you've got a machine that is, 20 years old, and you think to yourself, God, if I can buy something new, I can, produce a lot more product in a quicker amount of time. That's going to help me lower my expenses, and I can run 2 shifts instead of 3 shifts, and I can actually generate more product in the same amount of time. That's going to help me lower my expenses. Or you could have an investment that's going to help you increase revenue. So those are the key questions to think about when you're investing in your business. I really recommend to people that they track these things separately, and there's different ways you can do this in QuickBooks. If you're just starting out and you don't have a lot of activity yet, but you want to start tracking this, I help clients work with this in Excel, a pretty simple spreadsheet that I'll share an example of with at the end. But it's important to understand the money going in and money going out, especially because these types of activities that you see here in financing and investing, they're not recurring very often. They are usually like, if you borrow money from a bank, you're not doing that every month. You're gonna do that like maybe, once every couple of years. So you want to separate that from your financial analysis to make sure you understand the money that came in was money I borrowed from a bank. You need to separate that out from your sales from customers, even though they're both deposits into your bank account. So tracking these things separately is really important to understand what's really going on in the core part of your business. So what do you do with your profit or your net cash flow? First thing you probably say is, I'm going to take some money out because I need to pay my bills. Well, there's kind of a good order of operations to think about this, which is much easier said than done. But the first thing you want to make sure you do is pay your taxes. Make sure you're setting aside money, work with your CPA. I highly recommend you work with a CPA to not only file your taxes, but help you estimate what tax payments are required throughout the year, to make sure that you're not going to get hit with fines and penalties at the end of the year, or interest and penalties, I should say, when you file your tax return, because you didn't make estimated payments throughout the year. I don't want to make this a tax seminar, but working with a CPA is really important to understand that. You need to pay your debt, making sure that you're on top of your interest and principal payments with your bank. We teach a series with Liberty Bank, and one of the things they always say is it's really important to establish a relationship with your banking contact up front. That will help them get to know you, get to know your business, and also building that relationship will help. And if you run into any problems, you can help work with them, and they might be able to help work with you to figure out some solutions if you're starting to run into any difficulties. So establishing that relationship with the banker, keeping on top of your your debt payments, very important. Thinking about reinvesting in your business. We just talked about, if you've got, if you're making a profit, you've paid your taxes, you paid your debt, and you still have some cash left over, and you say to yourself, should I make that investment in that new software, or to maybe hire in some more people, or to, replace that grill in the kitchen? That's a way to reinvest back in your business if you can afford it. And then we always say, pay yourself last. Again, much easier said than done, because sometimes there are pressures on our personal financial needs that go in hand with our business financial needs. But it's important to remember these other things before you get to that last point of how much you want to take out. Again, the last two here are really discretionary decisions. The first two are not. So where do you start? Giving you all this advice here and all the things to look for. I highly recommend tracking your results in a financial software. I'm not an expert on any of these, but these are ones that some of our clients have used. Review your results monthly at a minimum, keeping good track of your books and making sure that you're entering things into your financial software. If you have a lot of activity and you're not, you don't have a lot of financial experience, and you need to hire a bookkeeper to just help keep things in order, it's okay to do that. Sometimes you can work with an accounting firm who does both bookkeeping services and tax return preparation services. It's okay to do that. Those are investments you're making in your business. I like to tell people, if you need to do that, definitely do it for your taxes, because as a business owner, your time would be better served off selling to your customers, finding new customers, coming up with new products and services to grow your business, than worry about complying with the tax code or researching new tax rules. Pay a CPA to do that for you. Think about that as an investment in your business. You're going to want to review your results monthly at a minimum. I recommend people enter their stuff in QuickBooks, and at least every month take a look at things. But there are some things you may want to keep an eye on more often. So definitely see what's going on in your business credit card, in your cash account. If cash is really tight, you may need to keep a really close eye on things week to week. So it really depends on what you have going on with your business, but at a minimum, you want to look at things monthly. And then you want to use the results to assess your business health. One of the things that I think people think is that, well, I need to keep my books in order for my taxes. That's true, but you can also use this information to help make better business decisions down the road. I like to say it's not just a record keeping or score keeping exercise. It can really help provide you some insight. So looking at your balance sheet, how much is my company worth, right? What do I have more assets and liabilities? Looking at that current asset, current liability analysis and saying, gosh, how much money do I have coming in the next, 6 to 12 months versus how much money do I need to reserve to go out? The income statement, how much is my company making? If you're a retail or manufacturing company, having that gross profit analysis, having your net profit, understanding, where your expenses are fixed and variable. And then your cash flow statement, am I managing my cash collections and disbursements efficiently? If you have got vendors that are, you're forced to pay your vendors within 30 days, but you're giving your customers 60 or 90 days to pay you, you're going to be in a cash crunch. So how can you get your customers to pay you as quickly as possible? And can you extend your vendors a little bit farther and still keep them in your good graces so that they don't cut you off? But managing that is going to help improve your cash flow, the timing of your cash flow coming through month to month. And then are you going to have enough cash to stay in business, right? That's kind of an important thing. And that's where some of the projection process that I'm going to talk about can come in handy. So this is kind of the next part of this is you have data, now what? And I like to say that, as I mentioned, it's not just about scorekeeping. You can use the past to help inform the future. If you're doing well, how can you keep it going? What's going well that you can continue to do? If you're struggling, what can you change? Where are the pressure points? A lot of times people will say, well, I've got to cut expenses. I can't afford to spend anything on that. The best way to grow your profit is to grow your top line, to grow your revenue. And that could be through finding new customers, that could be developing new products or services, or it could be increasing your prices. And that's what I'm talking about here, kind of how you can increase revenue. In terms of pricing, one thing to consider is the customer and the competition, right? There's this concept called pricing elasticity. And what this means is that think about the pricing, environment being a rubber band, right? It can only be stretched so far. You can only increase your pricing so much before a customer is going to say, nope, that's too much. I'm not going to pay for that. I'm either going to go without your product or service, or I'm going to go somewhere else for it. So if you stretch that pricing elasticity rubber band too far, it's going to snap. So that's something that you'll need to keep an eye on. And that's challenging because you got to consider the competition, who else is out there doing something the same or similar to you, and what's happening with your expenses too, right? The big thing that a lot of businesses have been facing the last couple of years, the inflationary pressure, wage pressure. A lot of people now are almost expecting price increases to come along. It's not too surprising now when you find out that somebody wants to, paint your house. The quote they gave you 2 years ago is much lower than the quote they're giving you now. It's common now because prices have been increasing. So that's difficult to navigate, but it's very important because if your vendors start pushing through price increases to you and you're not keeping pace with your own prices and the competition is, you may be getting some business because you're lower in price, but you may be suffering financially and not be able to make enough money to keep in business. Should you consider cutting back on some expenses? This can be, a helpful way to do things. My caution on this is, I used to have a saying that you can't shrink your way to success. Sometimes you need to spend money. You need to spend marketing money to drive revenue. Now, if you can get a better deal on your fixed expenses like rent, insurance, shop around for the best utility deal, great. That's a great way to save money because those are fixed expenses. And by and large, the service you're going to get is going to be pretty similar vendor to vendor. But you got to be careful in terms of things like, your cost of goods sold. If you find something that, like, give that t-shirt example I gave, if you're paying $8 and you can find a vendor who can do it for $4, is it still going to be the same quality? That's something to be, cognizant of. Or your customer is still going to be willing to pay that same $12 for something if it's a much lower quality. So marketing is another one. I'm not a marketing expert, but I do know that it's wise to spend marketing the right way if you can find the tools and techniques that are going to help drive some revenue growth. If you scale way back on marketing and advertising, that may have a negative impact on revenue, which again, kind of defeats the purpose of trying to grow profit. And do you need to prepare a cash flow budget? So this is something that I work with on clients sometimes where we'll say, if the client's just like, I have no idea where the money's going, I have no idea what the next year looks like, I'm worried if I'm going to be able to stay in business, we'll sit down and say, all right, let's do a budget. And this will help us figure out where the money is coming in, where it's going out, and then how we can plan. And are there some different levers we've got to throw to help improve things? So this is an example that I use with my clients. It's an Excel spreadsheet. It's a little overwhelming because there's tons and rows and columns here, but I'll just quickly show you how this works. It's very intuitive. It's a simple spreadsheet, but you can see going across the top, there's all of the months of the year. I recommend people do some budgeting by month because there's two important reasons. One is your business could be seasonal. I've used that landscape business example that I talked about, where if you've got a lot of revenue coming in, April through October, your revenue is going to be much different than it is in December, January and February. The other thing is that some of your expenses may only get paid once a year, insurance, taxes, things like that. So you're going to want to understand the cash flow volatility that can happen over the course of the year. I only showed the first 6 months here to keep this on one page, but what I try to work with clients on is kind of your top and your bottom row are basically your beginning and ending cash balance. And then going down in the rows, you've got money coming in the door, which is money from cash sales or collections from your accounts receivable. And then in this example, the business has, this is the money they have available to spend. And then these are all their expenses, their cost of goods sold, their fixed costs, and their variable costs. And then they have this thing called business operating cash flow. So this is that operating cash flow that I talked about earlier. This basically says, is my business making money from its core business operations? Before borrowing, before paying taxes, before me putting money in, is the business making money month to month? Revenue minus cost of goods sold minus expenses. So that's this business operating cash flow. And if you remember earlier, I said keep track of your financing and investing activities separately because they are going to skew your results. So down here, I've got some non-operating items. So I've got income taxes. I've got my loan payments because I borrowed some debt. Maybe I'm going to make some capital investments in my business, and maybe I'm going to take some money out for an owner's draw. And then I've got my, non-operating cash receipts. So this would be money that I've maybe borrowed or money that I'm putting into the business. So I'll just walk you through. We got a few minutes here. I'll just walk you through how this works. Just mechanically. So in this example, the business has nothing at the start of the year. They have no business in their business bank account. And they say, I'm going to borrow $5,000 from my bank. I'm going to put $10,000 of my own money in, and I've got $15,000 because I'm starting my business, and I've got $15,000 in my business bank account. So then I go to the next month in February, I've got $15,000 to start the month. Now I haven't started my business yet, so I don't have any sales revenue yet because I'm just starting out. But I've opened up my facility, so I've got some rent. I've got my internet and electric bills. So I've got some fixed costs that I've already started to have to pay because I need some startup time before I'm going to actually start opening my shop and start selling to customers. And I borrowed money, so I got to start paying back on my loan. So now I've got to start paying a little bit. And I also need to make some capital investments because I've got some startup spending I need to do before I actually open. So I spent in February $4,000. So you can see in the month of February, I haven't collected any money from customers because I'm not open yet, but my cash has gone down $5,000. So now I'm down to $10,000. Now we go to March. March, I start with $10,000. And this is kind of a rinse and repeat activity, right? So I've got my fixed costs that are there again, have to keep making my loan payment. I had to make another $2,000 capital investment. My cash is now down to $7,000. Then we get to the next month and now we're open. We've opened up and we start getting some revenue coming in. So I've got $1,000 of sales that come in. Now I've got $8,000 available and I still have to, pay some expenses. Now I've got some cost of goods sold because I've started selling some product. My rent is still there. I've got my, utilities here. I've got some supplies I needed to buy. Still making my bank loan payments. And now my cash is down $300. It's down to $6,700. And again, so this is, you can see how this kind of works, right? So the next month, again, it's more sales, and then here's a month I've got to make my general liability insurance payment. That's a one-time payment that I've got to owe it in this month here, in the month of May. That's $2,000. So you can see, I think the gist of this is that the goal here is to try to say, what do I think is going to happen by month? And mapping it out by the various categories, right? Where's my startup money going to come from, either through a bank or my own investment? What are my fixed and variable costs? What do I need to invest in for startup to, whether it's equipment or rent or whatever? What are my ongoing costs? And then when do I think I can open and start collecting revenue? I would say if you start to do an exercise like this, it can be challenging because once you start putting numbers in a spreadsheet, they become black and white and they feel real. But it is an estimate. You're guesstimating what's going to happen to try to understand kind of a proof of concept of can your business actually make money over what period of time? And I think the other important thing for this is this kind of exercise can really help you understand how much money you need before your business starts bringing in sales. And that's I think a mistake that a lot of people make up front is they start thinking about how much money they can sell without understanding how long it takes to get that startup phase before you start generating revenue. So this is just an example. All these are just kind of made up numbers just to illustrate the kind of thing you want to do as you're thinking about cash flow planning. Here's some key tips for budgeting success. I mentioned just, preparing an estimate by month. We talked about the volatility of your business. And then also if you've got expenses that are only paid once or twice a year, you want to put them in that month that it's going to be there. That way, you've got enough cash on hand to pay your insurance bill when it comes due in May. You can use your past results to help project the future, but you want to take into account new facts and trends. So let's say you're sitting here and you're like, it's the end of January and I want to do a cash flow plan for all of 2023. You can go to QuickBooks and say, let me go run my monthly income statement or cash flow statement for 2022 and see how my revenue went up or down throughout the year, and say, would that be a good indicator for how 2023 is going to go? But maybe you need to take into account different things, like maybe you changed vendors, maybe you moved into a new space, maybe you changed utilities vendors, maybe you added a second truck for your landscaping business, so your fuel costs are going to be higher. Maybe you increased your prices, so your revenue is going to be higher. So you can use your past results to help project the future, but you also want to take into account any new facts and trends that are coming along. So I advise people to use the 80-20 rule. And another way to say that is focus on what's going to move the needle. So an example would be like, if you're saying, well, I got to make sure I budget for my internet costs for my location. Don't worry if your internet cost is going to be $110, $130, $140. Put $120 a month in the spreadsheet and move on. Just get something in there because it's going to be close enough. Where you want to spend your 80% of your time are the things that are going to really impact your cash flow. And it's going to start with sales revenue. That's the hardest thing to predict because there are a lot of dynamics. Your product and service, your pricing strategy, how you're going to find your customers, what's the competition doing? Is marketing going to make a difference? Is there seasonality to your business? Ask yourself the question, what would I have to believe to generate $5,000 of revenue a month, $10,000 of revenue a month? How many things would I have to sell? How many clients would I have to see? How many hours would I have to bill out at? What would you have to believe to find that revenue? So a lot of times you may need to do a deeper analysis to quantify what your revenue might be month in and month out. So that's the 80-20 rule. Focus a lot of your time and energy on the things that can really move the needle. Because if you miss your internet expense by $10 a month, it's not going to make a difference. If you miss your revenue by $10,000 a month, that will make a huge difference. And then I've got this kind of sarcastic item in the bottom, which is remember the golden rule of budgeting. And I used to say this all the time when I was in planning in my job, which is the only thing we know about a budget is that it's wrong. It's an estimate. It's a projection. And once you start putting numbers in there, it's going to start to feel real because it's in black and white. But what you're trying to do in doing a budget is to find the guardrails. When you first start a budgeting exercise and you've got a blank spreadsheet, your range of outcomes is this wide. You want to find it to this wide. It's not going to be perfect, but find the guardrails and say to yourself, what would I have to believe to achieve this level of profit and cash flow month in and month out? And document your assumptions. Because if you assume that you're going to generate $10,000 of revenue a month and it's based on a certain number of billable hours, clients served, an hourly rate, do the math out in Excel. Because in 6 months' time, if you're dramatically different, you can go back and say, why was my revenue in April half of what I thought it was going to be? Let me go back to my assumptions. Oh, I assumed I would see 15 clients. I only saw 6. Maybe that's why it was so much different. So that's the golden rule of budgeting. It's an estimate, it's a projection, but you're trying to find those guardrails to understand what's the art of the possible, what do I have to believe, and what are the business actions I need to take to achieve the financial outcome? Because none of these happen without the business actions. You've got to find the customers, you've got to sell to them, you've got to hit your pricing targets. The numbers are just in a spreadsheet. The business actions are what create them and make them real.
Steve, you've got a couple of questions I thought you might want to mention here. One is, will you send the cash flow planning template to everybody?
Yes.
So that's an easy one. The other one is, are you going to explain break-even point?
Great point on break-even point. So let me think about the best way to explain that. I'll close this window here. So, yes. So break-even point is a good way to think about break-even point is fixed costs. So, your break-even point. So when people say break-even point, it basically means what do I have to sell in revenue to break even or have net cash flow be zero? And it's the way to think about it is you need to cover your revenue that you collect needs to cover your variable costs and your fixed costs to break even. So in my example earlier, let's say I've got, I'm selling my t-shirt, let's say for 20 bucks a unit, and it costs me $8 a unit. And I know I'm going to make $12 per unit. And that's my t-shirt profit. That's my gross profit. I need to do out the math and say, how many t-shirts do I need to sell at $12 a unit of gross profit to cover my fixed costs? Because that gross profit, if we go back to our income statement example, so your gross profit right here in this example here, let's go back to this one. My $12 a unit in my t-shirts, if I, sell 10,000 shirts, right? That's my, $120,000. I need to look at my expenses and say, what are my fixed expenses that I need to cover? And if I make $120,000 of gross profit and I have $120,000 of expenses, that's my break-even point. And I know I need to sell, 10,000 shirts. That's how many shirts I need to make to break even. And because my operating expenses and my fixed expenses are $120,000, every time I sell another shirt, if my fixed costs stay exactly the same, every incremental shirt I sell is going to be profit. So it's kind of a complicated example, but you want to separate out your fixed expenses and your variable expenses and know that your fixed expenses are going to stay, flat over time. Your variable expenses will grow with revenue, and you can do the math to say revenue minus cost of goods sold minus variable expenses equals what, and how much do I need to cover my fixed expenses? I hope I explained that well. I know that without a slide, it was kind of confusing to explain it that way, but hopefully that helped. All right, let me just get to the end here because we're just going to wrap up. So just some closing comments, and we have some time for additional questions. So basically, managing your business financial is an ongoing activity. It's not just once a year for doing your taxes. It's a good diagnostic tool to help, make decisions for the future. The three financial statements are all important. They each tell you a different story, right? The income statement says, what's my profitability over time? Your balance sheet is what's my financial health as of a point in time? And your cash flow tells me how efficiently am I collecting and dispersing my cash? And this budgeting process can help plan for risks and opportunities for your business. And this can be a useful tool for you as you think about that. And more importantly, we're here to help with SCORE. I help clients with this kind of activity all the time: financial planning, business planning, anything that you need help with, SCORE can help there. So that's what I have for prepared slides. Why don't we open it up for questions? I'm going to see if I've got something that shows break-even point a little better. So if we have any other questions, feel free to jump in.
Well, Steve's looking for that. I'll just point out something we run into with SCORE clients a lot. There's a huge difference between different types of businesses in the answer to that question, and it can vary year to year. If you take extreme examples like you own a ski resort, you own a ski shop, or you own a farm, those are businesses that have extremely uneven cash flows where you're spending a lot of money in some months and you're getting revenue in other months. And so, yeah, your break even for the year might be pretty late in the year. So that's one way to think about that. Whereas usually when you think of break even, it's like when you're starting a business. When am I first getting positive cash flow? That makes sense?
It does to me. Actually, I just found a slide. This is something I've used in other presentations. Let me see if this helps explain it better. Hopefully I don't further confuse people. Remember how this one works. Can you see my, you see this break-even analysis, John?
Yep.
Okay. All right, so hopefully this helps. So in this example, what you try to do here, let me just remind myself how this one works. So in this example, they've got a unit sales price of $225. Their unit variable cost is $100. So what that means is for every unit they sell, their gross profit is going to be $125 because it's the 225 times 100 times however many units they sell. And their fixed costs are $75,000. So if I do this right, I'm just going to double check my math here. Okay. So their fixed costs are $75,000. So if they sell this little cloud here says 600 units, if they sell 600 units times $125 a unit, that is $75,000. So they will cover their fixed costs. So what this shows here, going along this graph here, is the fixed costs are in blue. So you can see the fixed costs are $75,000 no matter how many units they sell. The graph going across here is units sold down at the bottom. So the fixed costs are going to be $75,000 no matter what. Your sales revenue goes up. You can see as they sell 300,000 or 300 units, their sales revenue is here, 600 it's here, and it continues to go up on this red line. And their variable / total costs are in yellow. So basically, if they sell 0 units, they have 0 in sales, they've got 75,000 in fixed costs and 75,000 in total costs. So they've got basically, that's where they're, they are right there. And then if they sell 300 units, their sales go up, but their variable and total costs are $105,000. So they're still underwater, if you will, because their costs are less than their sales. When they get to 600, this is where they're above water. And this is where this break-even point where the yellow and the red meet. And then as they grow, you can see that their fixed costs are going to stay the same over time. And as they continue to sell more money, their profit is going to continue to grow. This is sometimes called fixed cost leverage. The more you sell your revenue and your fixed costs stay the same, your profit gets incrementally better because you're getting leverage off of your fixed costs. I hope that helps answer that question better than I did before.
Good slide.
All right. So let's see. Looks like we've got another one here. What do you think about measuring spread on a weekly basis? Cash plus receivables minus payables equals spread. I think that's great. That is a great formula to look at. I hadn't heard it referred to as that, but that is your most current asset of cash, your next most current asset in receivables minus your most current liability, which is payables. That is a great calculation to look at every week. And I may actually steal that for next time I teach this class. And that's more important than looking at your whole balance sheet every week, because your fixed asset balance and your debt balance are not going to change much week to week. But if you look at this spread week to week, that's a great formula. I love it. All right, we've got a couple minutes left. Any other questions? Let's see anything. John, anything else I missed that you can
One
think of?
thing I'll just throw out, we work with a lot of clients who run services businesses. And as Steve mentioned, the cost of goods sold terminology isn't usually used in services businesses, but services businesses that do project work often have something similar, because they will track their labor costs associated with a specific project and calculate their net margin, their engagement margin for that project. So it's kind of like they're tracking the labor associated with the work on that project, whether it's painting a house or developing software or whatever it is, and saying, what's my margin on that project, independent of my overhead and other costs. So there are kind of unique metrics that become valuable within an industry that are analogous to what you do with cost of goods sold and gross margin, if that makes sense. I know in consulting business, which is where I made my living, that's the way we thought about things.
All right, we did have a comment come in here through the Q&A from Amy. Comment of thanks makes us very consulting. Okay, looks like it was just some kind words. Thanks. You're welcome, Amy. Thank you for joining. All right, we are coming up on 12 o'clock, so I want to be respectful of everybody's time. Thank you very much for joining. John, thanks for co-hosting this with me. We will send around a recording of this webinar if you want to revisit it. We'll also include a link to our YouTube page, which has a number of webinars that we've recorded in the past on a variety of topics for the Greater Hartford chapter of SCORE. And we'll send that around as well as the cash flow template. And again, if you need any help running your business, you can contact us at score.org and search for mentoring services, and we'd be glad to help you out. And thanks again for joining us, and have a great rest of your day.